Jai Hind to all and welcome to this video lecture of tax planning and management. The topic of discussion is clubbing of income and this belongs to unit number 2. What is clubbing of income? Normally, the general rule is that a person is liable to pay the tax on the income which he or she earned during the financial year. That means if you are earning a income, then you are liable to pay income tax if your income is more than 2.5 lakhs in case of individual. But in some cases, however, the income tax deviate from this principle and the SSC is taxed in respect of income which belongs to some other person. Means there are some specific provisions, some specific conditions where the income earned by some other person will be taxable, will be included in your income and you are liable to pay tax. This is known as clubbing provision. Clubbing of income means including the income of any other person in the SSC's total income. Obviously, if someone other's income will be added in the SSC's income, then he will be liable to pay more tax. The Income Tax Act has specified certain cases where income of one person is mandatorily required to be included in the income of other person. If the conditions are satisfied, there are cases and there are some conditions associated with the cases. Only on satisfaction of those conditions, the income will be clubbed. This inclusion is known as clubbing. For example, if a husband diverts some part of his income to his wife to reduce his tax burden, then such transfer of income of a wife is added and taxed as income of husband only, not his wife. There are some cases of tax evasion. These are the example of tax evasion. With the intention of tax evasion, sometimes a person, an individual, is transferring his or her income to the spouse, and suppose the tax liability of the spouse is nil. That means the total income is less than 2.5 lakh. In that situation, if he transfer the income to the spouse, then in that situation he will be liable to pay less tax, and as a effect of this transfer, the tax was evaded. It is a clear case of evasion, and so the clubbing provision is there. But sometimes clubbing provisions are applicable if there is no intention, no evasion to reduce the tax liability. Intention is not there, but still the diversion of income is there, so the clubbing provisions are applicable. Now, these are few examples. There are so many cases of clubbing in the Income Tax Act, but I am taking 4 or 5 cases for the reference. First case I have taken is transfer of income without transfer of asset. That means a person is transferring the income, but he is not transferring the asset. The ownership of asset is still lying with the SSC. When a taxpayer, while retaining the ownership of an asset, transfer the income from such asset to another person by an arrangement, by an agreement, or in any other way, such income will be taxable in hands of taxpayer. That means the transferor will be liable to pay tax. Transferee is not responsible. There are certain conditions. This provision comes under section 60 and the conditions to be satisfied are the taxpayer owns an asset. That means the taxpayer must be the owner of the asset. If he is not the owner of the asset, section 60 is not applicable. There will be no clubbing. The ownership of asset is not transferred by him. During the financial year, ownership remains with the taxpayer, remains with the transferor, and ownership is not transferred to anybody. Income from asset is transferred to any other person, and the taxpayer, the person, the SEC is transferring the income during the financial year to somebody else. The above transfer may be revocable or may not be. That means the agreement, the arrangement between two of them may be revocable or may not be revocable. If the above conditions are satisfied, the income from asset that was transferred by him would be taxable in hands of transferor only. For example, this we can understand with the help of an example. Suppose here is a person called Ankit. Ankit is an SSC. Ankit has his own house property in Delhi. He rented the property for 25,000 rupees per month. However, he has requested the tenant to make the payment of rent in his father's bank account. That means the ownership of that house property is still with Ankit. Ankit is the owner. He has right to receive the rental income, that is 25,000 rupees per month, but he instructed his tenant that make the payment in the father's account. That means he diverted the income. In this situation, although he is not receiving the income, his father is receiving the income, but still Ankit is liable to pay tax on 25,000, and this 25,000 rupee per month, that means total 3 lakh rupee per annum. This rental income on the let out property will be included in the gross total income as income from house property in the Ankit's computation. Okay, so because he is still the owner, he is only diverting the income, rental income, not transfer of the house. That's why the clubbing provision will be applicable. All the conditions of section 60 is satisfied and he is liable to pay tax on it. Another example is income of taxpayer's spouse. Spouse means either husband or wife, depending upon the case. A spouse income is required to be clubbed in hands of taxpayer if any payment is received by the spouse by way of salary, by way of commission, fees, or any other form of remuneration from a concern. It can be business concern, it can be company, partnership firm, sole proprietor, whatever it is, business organization, in which the taxpayer has a substantial interest. Substantial interest means either he has a voting power or he is a director, like that. So in that situation, if the spouse is receiving some payment from the business organization and the taxpayer has substantial interest in the company, in the business organization, in that situation, the amount, the income received by the spouse will be added back to the income of the taxpayer and he will be liable to pay tax. However, the clubbing income would not be applicable if the income of a spouse is related to his or her technical or professional knowledge. That means this provision is applicable only when the spouse is getting some salary or commission or fees, whatever it is, and he is not having any technical or professional knowledge for receiving that required for the employment. In that situation, income received by the spouse will be added back to the taxpayer. For example, Vineet has a substantial interest in a company. That means Vineet may have 20% of voting right, or he may be a board of a director, MD, or a director in boards. And his wife Ankita is receiving salary from this company without having any technical or professional knowledge and experience. Suppose Ankita is a CFO of the company, Chief Financial Officer of the company, and she is not having any commerce degree or technical degree for which is suitable for that position. In that situation, it is very clear that Ankita is getting the salary, the job, because of the influence of the Vineet, the position of Vineet, and in that situation, the salary will be added to the gross total income of the Vineet. In this case, Ankita's salary will be taxable either in her hands or in hands of her husband, depending upon total income, whose total income is higher. If Ankita's total income is higher, excluding the salary income, that salary income will be added in the ITR in the computation of Ankita. And if Vineet's gross total income is higher, then salary income will be added to him only. However, the exceptional case is there. However, if Ankita had received the said salary on account of her technical or professional knowledge, that means if Ankita is having some commerce degree or professional degree, which is required for that particular job, in that situation, her salary would be taxable in her hands only, not in the hands of her spouse. Another case is transfer of property without adequate consideration. That means there is a transfer of property, but property is transferred without any proper consideration. There are a specific clubbing provision when the taxpayer transfer any of the asset. Asset can be fixed asset can be intangible, tangible, movable, immovable, without adequate consideration. Adequate consideration means equivalent to the market value, that is fair value of the asset. Adequate consideration to the spouse or son's wife. Income of such asset would be added to the taxpayer income if the taxpayer is satisfying all these conditions. Transfer of an asset to his spouse directly or indirectly without adequate consideration or in connection with an agreement to live apart. That means this provision is not applicable when there is a transfer of asset because of an agreement to live apart. Divorcing, they are divorcing, and because of this divorce, because of their mutual separation, this asset is transferred. Then this provision is not applicable. Transfer of an asset to son's wife directly or indirectly without adequate consideration. Transfer of an asset to any person or association of person directly or indirectly without adequate consideration for the immediate or deferred benefit of his spouse or son's wife. It may be possible that asset is not directly to the spouse or son's wife, but it is transferred to some other person or association of person which is directly or indirectly for the benefit of the spouse or son's wife. In that indirect transfers, the clubbing provision will be applicable. For example, rental income received by the spouse from a house owned by the taxpayer would be clubbed with the income of taxpayer if the said house was transferred to the spouse without adequate consideration. If house is transferred because of the mutual separation agreement, then this provision is not applicable. Similar provision are not there for any relative other than a spouse or son's wife. That means if this transfer of property without adequate consideration is done to some other relative other than a spouse or son's wife, then this clubbing provision will not be applicable. This is applicable only in case of a spouse or son's wife. Now, what about the income of minor child? If a minor child is earning something because of his or her skill or without because of her manual work or without any skill or like that, this provision is applicable on that. There are certain exceptional cases. I will be discussing that one. Income of minor child is required to be clubbed with the parents whose income is higher. That means the income of minor child will be added to the income of either mama or papa, mother or father, whose income is higher. If parents are divorced, in that situation, the clubbing provision is there. That means it is not an excuse. It is clubbed with the income of the parent who is maintaining the child. That means the child is living with the mummy, then income will be added to the mother's income or vice versa. Once the income of minor child is added to one's parent's income, the same would continue for future year also, unless the tax officer believe it is necessary to change the same. That means it is not optional. If in 1 year, in first year, the income is added in the father's income, and in the next year, the income of minor child is added to the mother's income. It is not so. Once it is added to either of parent, it will be continue for so many future years, unless there is a reason to believe that it should be changed, and it will be changed by income tax officer only. The parent with whom the income is clubbed will be allowed an exemption of lower of actual income or rupees 1500 under section 10. Section 10 will give you an exemption, it will give some deduction, and the income of minor child is included in whose income, either mother or father. Deduction will be allowed to him only, and deduction is actual amount or 1500, whichever is lower. For example, Rohit has two daughters and he has opened fixed deposit in their name. The fixed deposit earned interest income of 5,000 each. Rohit should report interest income of 10,000 as a part of his total income. However, he would be eligible to claim an exemption of 1500 each child, that means total 3,000 rupee on his income. Hence, the taxable interest income for him from these fixed deposits will be 10,000 minus 3,000 for both of the child. 7,000 will be added to the Rohit's income. But if the income which is received by a child is because of his or her own skill or specialized knowledge or experience or manual work, then this provision is not applicable. That means if the child is earning by his own skills because of his or her working, then the income will be taxable in the hands of child only. No clubbing provision, no, it is not added to the parent's income. If the minor child is disabled, in that situation, disability will be defined under your chapter 6, that is section 80U. Disability may be major, may be minor. In that situation, minor child which is disabled and earn the income, in that situation, this provision of clubbing will also not applicable. That means that disabled child, in case of disabled child, the computation will be prepared in the name of minor child and ITR will be filed. Normal tax provision will be applicable without any clubbing. This is all. I'm discussing few cases of clubbing here. There are 2 or 3 other provisions which are discussed under 64. You can refer your textbook for these cases, but the popular cases I have already discussed. Thank you so much.